I've already said earlier in this series that the government will establish willfulness through circumstantial evidence. Circumstantial evidence are indirect facts that, when weighed together, tend to indicate to the government that somebody willfully intended their actions. Circumstantial evidence need not be slam dunk badges of fraud. It can be actions when viewed individually are legal, but when combined together into a series of actions start to look illegal. For example, it is not illegal to run an all-cash basis restaurant, for example. But the fact that a business is all cash, when added up with other factors, could indicate that tax fraud exists. Matter of fact, here's how that could happen. You're being audited. They show up unannounced at your business. There's a safe in the corner of the room. They demand that you open the safe. They find $10 million of cash sitting in that safe. If you haven't reported $10 million worth of taxable income in the recent past, that's how a badge of fraud could occur. Here's another example how independently legal actions could be added together to show indirect evidence that somebody committed tax fraud. In Voight, the government took technically legal actions on the part of a taxpayer and added them together into a pattern that showed willful intent to commit tax evasion. In U.S. versus Voight, the taxpayer 1 decided against purchasing some jewelry with cash when he discovered that a report to the IRS would be required to show the government that there was a cash purchase. This businessman went further in requiring his clients to fill out certain confidentiality agreements that forbade them from disclosing details of his transactions with them. And he maintained an overseas bank account. These individual actions were added together to show fraudulent intent. The court stated that it had no difficulty in believing that a jury could weave these facts together and create an inference that the taxpayer intended to commit tax fraud.